Ever though about how day traders make money trading stocks? Most used what's called the 20-day moving average. The 20-day moving average, MA, is a technical analysis indicator commonly used in the stock market to analyze trends and smooth out short-term price fluctuations. Always follow the trend. When the stock price is above the 20-day moving average, it suggests that the stock is in an uptrend. And when the stock price is below the 20-day moving average, it suggests that the stock is in a downtrend. Traders and investors often use crossovers between the stock price and the 20-day moving average as signals for potential buying or selling opportunities. When the stock price crosses above the 20-day moving average, it may signal a bullish trend, indicating potential buys. It's crucial to understand that no indicator is foolproof, and it's always recommended to use multiple indicators and analysis methods to make well-informed trading decisions. Additionally, past performance is not necessarily indicative of future results, and risk management is a key aspect of successful trading. Now let's look at the death cross. Price crosses below the 20-day MA, traditionally considered a bearish signal, indicating a potential downward trend. It's important to be careful. While crossovers can be useful, they are not foolproof, and false signals can occur, especially in choppy or ranging markets. Traders often use additional technical indicators or analysis methods to confirm signals and reduce the likelihood of false positives. It's important for traders to understand that the use of the 20-day moving average is just one component of a comprehensive trading strategy. Successful trading is not solely dependent on the probabilities associated with one indicator. Risk management, including setting stop-loss orders and position sizing, is crucial to mitigating potential losses. Combining it with other indicators, fundamental analysis and market sentiment can provide a more holistic view of the market and enhance the probabilities of making informed trading decisions. Emotions can play a significant role in trading. Develop emotional discipline and avoid making impulsive decisions based on fear or greed. Also, stay open to continuous learning and stay updated on market trends, trading techniques, and new tools.